Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we are going to learn a concept that is vertical analysis of common size. So basically, we'll be studying three aspects over here: horizontal and trend analysis, vertical analysis, and ratio analysis. These are the three things. What is the horizontal and the trend analysis? It basically compares the financial statement to determine the dollar and the percentage changes in the amount and in the percentage change. And the second is it computes the dollar change with the percentage change. That's the same thing. Vertical analysis, it shows the relationship of each item to a base amount on the financial statement. So it says that what is going to be the percentage of the total amount. In income statement, each item is expressed as a percentage of a net sales, and that of balance sheet, each item is expressed as a percentage of the total assets, right? So here assets is taken as the benchmark for percentage purpose, and over here sales in case of the income statement. The ratio analysis, it puts the number in the perspective with the other number we are comparing, right? And it helps to control the different sizes of the firm. Ratios provide a meaningful relationship between the individual values and the financial statement. So let's understand what is the vertical analysis, or commonly known as the common size. See, the vertical analysis of a financial statement is done using three methods we just saw: horizontal, right? Then we just studied vertical and ratio analysis, right? Okay, so in this tutorial we are going to discuss about vertical analysis or the common size statement in detail. Now vertical analysis is basically, you can say, it is a technique used to identify where the company has applied its resources, and you can say that how far those resources have been used. They are distributed among the various balance sheet and income statement accounts. This analysis basically determines the relative weight, you can say the relative weight of each account on its share in asset resources or revenue generation. Third, in the vertical analysis, each element of the financial statement, both I'm talking about the income statement and the balance sheet, are shown as a percentage of the total assets. So in case of the income statement, each element of income and expenditure is defined as the percentage of the total asset. So total asset, not the total asset, the total sales. Now, as an example of vertical analysis, let's take a balance sheet of Tata Group of Company as on 30th 9, and let's try and understand things in here. Now, this is the balance sheet of Tata Limited. If we only look at the above balance sheet, the liability and asset which is available to us, it doesn't actually make any sense over here. But let me convert each and every element of this balance sheet as a percentage of the total. That is this 119,020 common size balance sheet. Then the balance sheet will appear something like this. So now this is how the balance sheet will look like. It is the percentage over here. Everything is in percentage form. So now we have a look at the balance sheet. We have look at the above balance sheet. As you can see, the assets and liability look, I mean, my question is that, does it look much intuitive, right? I mean, when we perform the vertical analysis, the data provides financial insight. So in this case, for making the common size balance sheet, we have basically converted all the elements of the balance sheet, let it be liability and the asset, as a percentage of the total amount. So over here, the liability is going to remain the same. The liability and the asset total is going to remain the same. So all this amount is the percentage of the total amount. So on a standalone, we can derive the conclusion from the balance sheet that the reserves and surplus, that is the RNS, the reserves and surplus, is 58.3%, and it is the highest portion. The company is having huge amount of reserves in it. The debt to equity ratio in this company is 19.6, that is the long term borrowing, plus you can say you will need to divide this long term borrowing by the total 1, so you'll get 0.33%, so which is completely low in this scenario. And that means the company is not using much of their long term borrowings or debt in the company. The more debt brings the financial leverage and tax savings. Now majority of the reserves or surplus is invested in the non-current I'm repeating, it is invested in the non-current investments. As you can see over here, these are the non-current investments, that is 42.5, 43.9, and most of the long-term borrowing, which is 19.6%, okay, are invested into the fixed assets, 42.5%. Now, company predominantly invested in non-current investment than the current investment. So the company is a huge capital intensive company, as an investment in the non-current assets, right? Or in the non-current assets, especially the fixed assets. Sorry, the non-current assets, especially the fixed assets, which is the especially is very high, which is nearly around 42.5%. So companies trade receivable, if you just see, it's just 0.7%, whereas the trade payables over here is 5.6%, right? And this means that company is not giving much credit to debtors, whereas it it is enjoying the credit period of its creditors, as you can see. So as seen from the above vertical analysis or the common size statement, it can give you a lot of better insight from the help with the help of these percentage which have been used over here, okay, and of the financial statement of the company, and then when you look at the same otherwise, right? Now vertical analysis of the financial statement over different period, if you try and look now in the continuation of the above common size statement that we just learned in example, now compare the 2 years balance sheet of the same company. See, look at this. This is the 2016 data and this is the 2015 data. We just knew this is the total, right? And we made the percentage. Now we have converted this into percentage form, and once we convert the percentage form, the same will look something like this. This is how it is going to look like something. See, after conversion of the 2 years balance sheet, we can derive that reserves are marginally they are marginally increased by 2% from 56.7%. This means the profitability must have increased. You can see from 56 to 58.3. The long-term borrowing have decreased by close enough to 1%. This means that some marginal repayment of the loan must have happened. Now, if you see the short-term borrowing, there has been increase in the short-term borrowing by clearly a 1% flat, and inventory level, as you can see over here, has remained the same, close enough to 6.9 and 6.6, almost the same. So there is marginal increase in the trade receivables also from 4.4 to 0.7. The share capital remains the same, and that means there is no fresh issue of the capital. Now let's go and perform some common size of the income statement for different period and analyze the same on the standalone period basis and for different years. Now as you can see, this is the P&L account of the Tata Group company for 2016 for different quarters, as you can see from 2015 itself. So a plain looking at the above income statement might be a little bit confusing. So let's convert the same as a percentage of the sales or total income from the operation, and it will look something like this. So this is the final look of after converting into the percentage from. See, following conclusion can be drawn from after converting the same as a common size financial statement. There has been reduction in the purchased of the finished goods, okay, and the semi-finished steel and the other product, as the percentage fell from close enough to 3.3%. As you can see, the 3.3% in December 2015 to 1.4% in December 2016, and the raw material consumption is close enough to in the 23% segment, right? So minus 23% remains as the past trend. Employee cost has reduced by 11%, okay, probably reduced from the 11% in December 2015 to 10.1 and then 8.5. Okay, now the power cost too has reduced from 6 to 5%, okay, and the total expense reduced considerably, around close enough to 91.5% in December 2015 to 82 you can say 2% in December 2016. Even the tax expense has been increased 3 times from 1.6% in 2015 to close enough to 4.2%.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.